welcome back to the next episode of Confessions of a Property Investor. Today, I've got a wonderful guest with me, Stephen Lewandowski from Lewandowski Accounting Group. Hi,
Okay.
Stephen.
How you going?
How are you?
Good.
It's good. Welcome. Thank you for coming on.
That's all right.
Good. So, Stephen, I've known Stephen for a while. Stephen is the accountant for Chase Wealth Australia. He is also my personal accountant. And Stephen also is the accountant for pretty much 90% of the clients through Chase Wealth Australia. He has proven himself beyond any measures of his suitability to the cause.
Thank you.
I guess he loves property investment.
Correct.
And he keeps us in the right path when it comes to the tax benefits and the guidelines within for property investing. So today, I think it's going to be a reality check for a lot of our listeners and viewers on, what truly are the benefits of tax benefits related to property investing. Steve, I guess it's where we'd start off is that a lot of our clients that come in, they know basically, generally that they can deduct things on tax, and they've heard through a friend of a friend that, that's tax deductible. It's all tax deductible. You can deduct this, you can deduct that. I'm not an accountant. I'm not a tax expert. When it comes to those sort of questions within a consultation, I'm at a loss at times. I give them general view, but I really don't know the ins and outs like you do. And I guess what we need is from you is the reality of its tax benefits. What, there's questions that I get like, should I get an old property or a new property? Do you want to shed some light on us?
Look, for sure. I mean, I've been doing this for a long time, like you said. And as I guess I always say to you is that it's better you get those questions come to me instead of going through you, because this is what I do every day. I don't do what you do. I don't fix my own car. I do tax and we do property. So I've got 6 myself, so I know what properties are like to have them and what you can claim. And I think having an accountant, it's a good idea to have an accountant. You don't have to have one. You can do it yourself. But it's just to know what you can claim and probably more importantly, what you can't claim. Because some people claim things they shouldn't be claiming. Tax obviously is right on top of properties at the moment, so it's better to just get it right.
Great.
Exactly. So, but if you get it right, it's nothing to worry about.
And
you just claim what you can claim and that's it. And it's just knowing what you can claim.
And I guess, Stephen, you tend to be as informative as possible with our clients, but it's really hard to stay on top of everything because it's something that does sort of organically change year to year. Can you give us, I guess, our listeners and our viewers some insight on a couple of things that they would probably ask? And I'm going to be very vague here. I'm going to think of some questions. I guess it would be general public theory is most things, if not everything, is tax deductible related to property investments. What is the reality? What is it that you could think of that you probably couldn't claim?
To put it simply, is you have in the purchasing stage, a lot of those things aren't deductible in your tax return. They relate to your cost base. So you still want to keep track of them. We still got to record them all, but you're not getting a claim for them right now. Although some things are, not a lot of things, but some things are. And that's again why having an accountant helps, because you know what things can and what can't be claimed. After it's bought, the property, then most things are deductible. Your rates, your water, your insurance, your body corporate, all those things are claimable. If you do renovations, we have to depreciate that, so it's not all claimable. If you do repairs, we've got to look at what kind of repair there is, that it is. So, but most things are. Interest on your loan, agent's commission, all those kind of things. Pest inspections,
Good. And I guess one thing for clarity as well is I have a lot of clients, or I have had a lot of clients that assume that they've expended, $70,000 worth of costs pertaining to the transaction of the property purchase. They then assume that they're going to get the whole 70 back. And this is where where you step in,
It's common and it's understanding. And I think that's where you can ask these questions after you bought the property, and that's fine. I think during the process is probably a good idea, just so you're aware of the outcomes of what's going to come out like afterwards. The other part that's important is because from a tax point of view, we can say these are our claims and this is what your negative gearing is going to be. But what your income is also important, because saying that you have rental income, for example, $30,000 for the year, your deductions are $40,000 for the year,
Yep.
you've got a $10,000 loss. Now, if that loss is in your name and you've only earned $20,000 for the year, you're not getting a refund because you haven't paid any tax.
Yes.
You're not getting a refund.
Correct.
Okay? So, whereas if your income's $200,000 a year, then you will be getting a refund.
Yes.
So it does depend on your situation, and that's also what's important to figure out. What percentage do you put on the property? Do you go 50-50 on the property? Do you go 90%, 10%? Do you put it all in one person's name? When we're talking about individuals, it will make a difference as to what the current claims are now, and also in the future for what the capital gains are going to look like.
And is that sort of based on what they earn at the time of the transaction?
Generally
Steve?
speaking, yes. It's what they're earning now, but I think you also need to look ahead a little bit because it depends on the age of the person. If they're getting close to retiring, then their earnings are going to be different.
Right.
If they're mid-30s, they've got a lot of years left of working, then you look at them and say, well, what's your incomes now? Do you think it's going to change? And what percentages should you go with? And 50-50 a lot of time is fine.
Yes.
There's nothing wrong with that.
Yes.
But it depends. You might have one that's earning a lot more than the other one.
Yeah.
It can be more beneficial right now to have a 90-10 split. You've just got to be aware that in the future, the capital gains are going to be different in the future as well if you sell it while you're still working.
Okay.
So there's unknowns, there's things you may not know for sure, but it's just knowing what the options are. And I think that's why it's important to talk to someone about it in the beginning so you know what the outcomes are going to look like. Yeah.
I agree.
Yeah.
I agree. I don't think that it can be a fully successful transaction or even a success in property investing without an accountant.
I think so,
I think you're very much part of the equation.
Yeah.
I'm iffy and a little bit 50-50 on planners, financial planners. I do think their expertise are probably they're more generalised more than this property.
It's more in shares. Generally speaking, you have advisors who do property, and that's completely fine. And they will probably know the tax side of it, and they probably have a tax license, so they'll probably be okay.
Yeah.
But you can research things and you can look online. And again, people that I know do their own tax, and there's nothing wrong with that.
Yeah, of course.
As long as you're comfortable that you've got it all covered.
Yeah, well, that's the thing. I'm not.
Yeah. And a lot of people aren't. No. And that's why you go see one.
Well, another question I get, Steve, is, property. Kath, I'll say to them, this property is brand new. People are hesitant at the moment buying off the plan. And I do understand their reasons for that and totally get it. And we tend to seek properties or to sort properties that are somewhat in construction or newly constructed, which is getting less and less as the months are going on.
Yeah.
But one of the main questions I get is, Catherine, what is the difference if I get an old property or a new property? And I do give them the general understanding with depreciation, but if you could just give us the benefits of either or.
And that's the key word, it's the depreciation. Your council rates, your water rates, those things are going to be the same with what kind of property you've got. It's the depreciation is the key because on 9th of May 2017, rules changed for individuals and rules changed for super funds so that an existing property, if you buy one, you can only claim depreciation on your capital works, which is your building, those are the structural kind of things. If you bought an existing property, the oven and the stove and the dishwasher and the carpet, whatever else you've got in there, can't depreciate any of those things on an existing property. If you buy a new oven, that's fine because you have a receipt for it. But anything that's existing, you can't. If you buy a new property, it's all new. It's never been rented before. It's never been claimed before. So therefore, everything's still deductible. So the biggest key is just that depreciation difference on a new property versus an old property.
Awesome.
And that's it. And that applies for super funds and individuals, not for other entities, but just for those two.
Awesome.
Yeah.
And that's good. That's always been my understanding, and you've explained that very clearly. Especially, I do remember when that change came in. Does the grandfather rule apply there at all?
No. Anything you buy now, no. That's it. So and if it's an existing property you had before then that you lived in, for example, and now you've decided that I'm going to move out, we're going to rent it from today, it won't work because you're renting it after that date. Yeah,
that makes sense. I guess another thing that that I get asked, and a lot of people are very nervous about body corporate fees. A lot of people are very nervous about, I'm paying all this money on body corp. Do I see it back? Does the dwelling itself, I know there's house and land, there's houses, there's apartments, there's townhouses. Do you feel in your profession, Stephen, that there's a big difference in any losses or gains there? Do you feel that pretty much
you've got to be mindful of the costs. So definitely. You buy a standalone, you've got your insurance and you've got full control over everything. the rates are going to change. Obviously, your water's going to change, but it's just your bill. The issue with body corporates is, yes, you're not in control of what's getting done. And then the decision may be that enough people vote that the new cladding's got to get done, or we need new fences, or we need a new driveway. And you may get outvoted. It's still going to go ahead. And you've got to pay your percentage of whatever the bills are. And yes, a lot of these things are tax deductible, but it's still money coming out of your pocket.
Yeah.
So
at the time.
At the time, exactly. So I always say to people, if you're trying to compare an existing property, same price, same you're going to buy, and you got one right next door that is in a body corporate, same cost, same type of property, but you just got one standalone and one not, you really got to consider going with the standalone, just from the cost point of view. It's not advice, I can't give that, but you just got to weigh it up. And when you look at it, you've got to say, well, what are the costs coming out? And tax deductions are great, but I'd rather, the end game is everyone has positively geared properties.
Well,
you don't want to have negative. We have negative in the beginning, and there's tax benefits, and we get that, and we maximize that. But ideally, if you can get to the point where they're all positive, it's money in your pocket. That's where you want to be. So you just got to look at the costs. Yeah.
Totally. Awesome.
Yep.
Another one, I guess, that I get a lot, Stephen, is we've been through sort of the common deductions and that sort of thing. Is there percentages is one thing that I always get lost on because it changes so much. And you've always sort of taught me rule of thumb for generally what people get back. One thing that I find when you say something is 100% tax deductible, can you explain to our listeners what that actually means? So, for example, for a split loan.
Yep. So you look at any of the deductions on the property, and if we say that like your counter rate's 100% deductible, the interest on your loan 100% deductible, all those expenses 100% deductible, and what that means is you have your rent for the year on the property. Say it's $30,000 a year, and you have your expenses, and we add up all those relevant expenses you've got, including your depreciation, including the interest on your loan. We add up all those things that you've spent, and you claim that as your deduction. So you have your $30,000, you have your $40,000. That creates your $10,000 negative.
Right.
That $10,000 negative, in effect, goes in your tax return, no different to donations or clothing or mobile phone bill, whatever it may be. It's a deduction. So then what percentage you get back depends on your tax rate. So if you're on $200,000 a year and you're at the highest tax rate, you're going to get almost half of that back in your refund. Purely looking at that only. It's not.
Did you hear that, guys?
Yeah, that's how it works.
Very important.
Yeah, so you're not factoring obviously everything else in. They may have interest, they may have dividends, whatever else. But purely looking at the property only, you're going to get back about half. If your income's $80,000 a year, your tax rate's lower, which means the benefit, the percentage, as you said, percentage is going to be lower.
Yes.
So having a set percentage for one person doesn't apply. It's knowing that's what your tax deductions are going to be. And again, that's why you've got to look at the position and your situation to say, well, what's my income? You might have a husband and wife. The wife's about to go on maternity leave.
Yes.
She's not going to work for 12 months. Her half will probably give her hardly any benefit at all because her income is going to be very low.
That is
it happens.
I'm so glad you've said that. And this is why listeners and viewers, my accountant has taught me to look at the ATO calculator very, very clearly when I put in each and every one of your incomes and try to give you a number. One thing that we can never promise you is an exact number, and things like change. Stephen just said, it changes all the time. So, thank you. And that's something that you do clarify for our clients quite regularly. So it's great. Now, we all know, Stephen, that Chase work very, very closely in the property section when it comes to having a property within a self-managed super fund. And self-managed super funds are something that have really taken to popularity, dare say over the last 5 years. I'm just noticing that everyone or every second person you speak to has a self-managed super fund. We have some pros and cons for a self-managed super fund that I have taken our listeners through in the past, but I would love it from your professionalism and your sector. If you could, advise our listeners of where you think the pros are in having a property in a self-managed super fund and potentially what they need to look out for in an accounting point. Of that.
And that's what I was going to say. I'm not an advisor. I can't be advising you to buy or to not buy a property. That's not what I do. But I can tell you how it works. And having a property in a super fund, if that's what you want to do, it's not a bad idea at all. The money's there. If you prefer to not be in the share market, you've got cash there with your deposit. And we know finding a deposit's usually the hardest part to buy a property.
Yes.
So if you've got the deposit and you can get a property that's not too negatively geared, then you've got it covered. You also got to remember too, in the super fund, you got your contributions. It's also going to help. So it's not just the rent going in. You've also got your work contributions going in as well. And that all goes towards paying off the mortgage, paying off the council rates, rest of the costs. And hopefully there's money left over and the fund's still going up in value. And that probably then leads into, that's the positive. The negative is that if you are a bit short, and as we know, rates have changed a lot recently, we know that. So as rates change or as costs go up, or if you lose a tenant and you've got no tenant for 4 months, or you lose your job and you've got no contributions, things can change. If you don't have the cash flow in your fund to make the repayments or to pay your bills, then you're forced into putting some of your own money in.
Yeah.
Which is a negative on a cash flow point of view, but there are still tax benefits. You can claim that potentially, depending again on your situation.
Yes.
You can claim that as a concessional contribution. You'll potentially pay no tax in the super fund, and you'll get that percentage back, just like negative gearing your tax return. No different to, again, a phone bill or a donation. So there are tax benefits to that, and hopefully you don't have to continue doing it.
Yes.
You get a tenant in, rates go down, all those kind of things change.
RBA.
That's what we need, exactly. You need rates to change.
Yes.
But yes, if that can happen, if you've got the funds in the super fund to cover it, then it just runs itself.
Yes.
And from a tax point of view, yes, you've got to get an accountant to do the accounts for you. It's got to get audited. There's compliance, which, again, with all your clients, we go through all the steps about what you need to do. There's a lot of compliance.
Happy days when that happens.
Yeah, a lot of compliance.
Yes.
It's not difficult. It's just knowing what you need to keep and what steps, and it's just documentation. You know what to keep, and it's not hard to do.
And it's pretty much for everyone out there. Don't ignore the accountant when he sends you an email asking you what he needs, because then the ATO sends you the next letter, and you don't want that.
Exactly.
So, you know, we want happy days. That's what we want.
Lodging on time, keeping them happy. That's exactly what I want to do. Exactly.
And then then the accountant gets narky because he has to do everything in 3 days.
Yeah, that's right. Yeah, deadlines
and then
aren't
I have
great.
to hear
Deadlines aren't fun. No, exactly. But there is one other thing. So when we're talking about super funds and talking about rental properties and talking negative gearing, a lot of clients will come in and they're saying, well, I've got a personal property already. I get $15,000 back a year. It's negative. I've got good depreciation, all these kind of claims, which is great. And their incomes are high. That's really good. And then it comes to their super fund and they've got a similar property and they've got similar negative gearing. And they're asking, okay, so where's my refund basically coming? It doesn't work the same way in a super fund.
No.
Super fund, you're not paying any tax during the year. So you don't have a refund to come back to you if you haven't paid any tax.
Yes.
What that negative does, though, is it will offset the tax that you would normally pay on your contributions. So your work contributes $10,000 into your industry fund.
Yep.
They're taking out 15% tax.
Yep.
You're losing $1,500. If those contributions go into your fund and the negative gearing covers the contributions, you're not paying any tax in your fund. So you've saved that $1,500. So it's not a tax-free fund, it's a tax saving.
Yes.
It probably won't be as big as what you get personally. That's usually not the way it works. And if you have an overall negative, that loss doesn't get lost. It stays in the super fund.
Yep.
Accumulates from year to year. And then when the time comes that you do sell it and you make a capital gain, we all hope, then that loss will offset against your capital gain. So then it's going to reduce your tax in the future. So it's not lost. You just got to remember that the tax side in the super fund is definitely secondary, as it should be personally as well. But you get the right property and you want to go up in value. You're not so worried about the negative gearing. And individually as well, it's the same thing too. I mean, this is your area, not my area. But again, you've got to worry about the property you're buying has to be a good property. The tax perks have to be secondary.
Well, Stevie, you just said it perfectly. And you're very right. And that's where our expertise does kick in with the property. It's getting a lot harder now to be able to allocate the right property within a self-managed super fund, because again, it's that negative concept.
Yeah.
The rents, the property capital is climbing a lot quicker than what the rents are.
Yeah.
So it's very hard to, and where the rates are where they are at the moment, I can't think of one strategy I've put together in the last 6 to 8 months that's been neutrally or positively cash flowed.
Yeah.
And the question that I have for my clients is, are you prepared to maybe, tip in $10,000 for the year to make $60,000 in capital?
And that's what it is. And that's what we see as well when we're doing financials for any clients that have properties, is you've got to weigh up that yes, a lot of them at the moment especially are negative, and they're
Yep.
making losses from a cash flow point of view,
Yep.
and even from a tax point of view, and that's fine as long as we see the values of the property going in the right direction. Not going to be every year, but as long as overall it's going in the right direction, then you're covering that loss. So you'd say, why did I do this? That's the reason why. Okay, I lose 10,000 a year to make 50 a year. Kind of makes sense.
Yes,
yeah,
that's
right.
right.
So it's a little bit of short-term pain for the long-term gain. That's what you're going for.
Well,
yeah.
that's it.
Yeah, that's what it's about. Yeah.
Well, but
yeah.
thank you, Stephen. It's been, you always tend to shed some light on our team when it comes to these intricate details. It's Chase Wealth Australia, not licensed accountants or financial planners by any means. We're property, but we rely quite heavily on the Lewandowski Accounting Group to give us the details we need to make sure that your property journey is a safe one. And I think that's where, Stephen's been in accounting, 25 years now? Nearly 25 years, like me with property. I know we sort of got rolled out of high school and got into it straight away.
Into it, yeah.
He's got 2 offices, Melbourne based, but he does it, nationally. He's got a great team that we deal with. And
location's not as important nowadays.
Yeah.
We have internet,
Yeah,
so we're fine.
true,
Yeah.
True. Tends to Zoom, but if you ever want to meet him and that, he's very personable, and I think that you're quite knowledgeable in this area.
Yeah, thank you.
So to all our listeners, when you do take that step for property investing, to make sure that your risk is mitigated, I would strongly advise using the right accountant. There's some accountants that are not property driven.
Everybody does it.
Yeah.
I don't do everything
They don't
either.
like
so
it.
no,
Yeah.
but property I do lots of. So yeah.
Good on you. You chose the right path.
That's right. Yeah.
Yeah, that's
Yeah.
it. Well, thank you, Stephen.
That's okay.
Appreciate your
Pleasure.
time today.
Yeah,
It was
fun.
great having you on the show.
Yeah, good.
All
Thank
right.
you.
Thanks, our listeners, and we'll see you next time for an amazing podcast about the property cycle that occurred, or I guess the property update for Q1 of 2024. Stay tuned. Thanks a lot.